You are not broke because you're bad with money. You're broke because nobody explained what a raise actually does to your paycheck. And the system is not designed to correct that misunderstanding for you. That's an expensive education to skip. Here's what's actually happening. When you move from $65,000 a year to $75,000 a year, your brain registers a $10,000 raise. Your bank account receives something closer to $6,800 after federal taxes. Social Security and Medicare take their share. Then your state steps in. Depending on where you live, that number drops further. You got a raise. You also got a higher tax liability, a new withholding rate, and a spending mindset built around a number that doesn't exist after April. This is why people feel confused. The raise was real. The feeling of being richer was not. Number one reason you still feel broke is lifestyle inflation, and it moves faster than your direct deposit. Here's the deal. You get a raise, and within 90 days, your fixed monthly expenses have quietly expanded to absorb most of it. You moved apartments. You upgraded your car payment. You stopped meal prepping. None of these decisions felt dramatic at the time. That's the point. A 2025 Goldman Sachs report found that 40% of households earning over $500,000 a year still describe themselves as living paycheck to paycheck. That's not a budgeting problem. That's lifestyle inflation running unchecked at every income level. Your spending didn't wait for permission. The raise didn't fail you. The behavior after the raise did. Number two is the apartment math nobody walks you through. The most common version of this happens during the college to career transition, and it costs people years of compounding. Imagine someone landing their first real job at $50,000 a year. In school, they were splitting a two-bedroom with two other people, paying maybe $500 a month for their share. After the job offer, they decide they've earned their own place. A one-bedroom apartment in most mid-sized cities runs $1,200 to $1,500 a month. That's a $700 to $1,000 monthly increase in a single line item. Over 1 year, that's $12,000 in additional rent. Their raise was $50,000 minus their previous income. The upgrade consumed the majority of the financial benefit before they noticed it was gone. They're not irresponsible. They just optimized for comfort instead of net worth. And nobody told them those were competing choices. Number three is the psychological math you're doing wrong. When you get a raise, you calculate what you can afford based on the gross number. You think in $75,000 a year. You spend in $75,000 a year. You save in $58,000 a year because that's what actually clears after taxes and deductions. That gap is where the confusion lives. It gets worse when you factor in the pain of paying problem. A 2016 report found that people spending with cards average $112 per transaction. People spending with cash average $22. That's a 409% difference. Now add a higher income, a new credit limit, and the dopamine feedback loop of online shopping, and you have a situation where the raise funded a spending upgrade you can't actually track. Your income went up. Your financial awareness of where the money goes did not. Number four is the tax withholding trap that punches you in February. Most people don't update their W-4 after getting a raise. The employer continues withholding at the old rate. You spend the year feeling slightly better off than expected. Then you sit down to file in February and discover you owe the IRS an amount you did not budget for. The raise was real. The money you spent as if it were yours was not fully yours. It belonged to the federal government, and it was just traveling through your checking account on a delayed schedule. Talk to your HR department after every income change. Adjust your withholding. Stop treating your tax refund as a bonus. It was never a bonus. It was an interest-free loan you gave the government because you didn't update one form. Number five is the savings rate problem, and the math here is blunt. If you earn $65,000 and save 10%, you're saving $6,500 a year. If you get a raise to $75,000 and your savings rate stays at 10%, you're saving $7,500. That's $1,000 more per year. That sounds like progress. But if your rent went up $400 a month, your car payment went up $200, and your food spending increased by $150, your monthly expenses grew by $750. Annualize that and you're spending $9,000 more per year than before the raise. The $1,000 in additional savings doesn't survive the math. The raise needed to increase your savings rate, not just your savings dollar amount. If your income goes up 15% and your savings rate stays flat, lifestyle inflation has already won. Every raise you get from here forward should come with a decision about what percentage of it goes to savings before you spend a dollar of the rest. Make that decision in writing, on day one, before the money arrives and starts making its own plans.